Good afternoon, this is Christian Thwaites of Brown Janikowski, the afternoon of Thursday, March 24th. This was the week which we saw a terrorist action in Brussels, which left many of us shocked, and our hearts and sympathies go out to the families and victims. It was, as you would think, a quiet week in the market. Some of it was reacting to the terrorist incident, which meant that treasuries rallied a little bit on Tuesday. But probably the bigger influence was that we're about to go into a 4-day weekend in most of the large markets, and so activity was mostly muted and positioning ahead of 2 days of the markets being closed. We saw the US stock market drift sideways. We're quite glad to see that. It had a 5-week run-up, and the 10-year Treasury come in about 1.9, which is slightly below its 1-month trading average. Take a look at this chart. This is some interesting research that came out this week from Grantham Mayo, a fund management organization out of Boston. And they looked back over the last actually 100 years, but here you can see it almost for the last 50 years, of what kind of action and influence the Fed had on the stock market when the Federal Open Markets Committee met its 8 times a year. And the short answer is quite a lot. The stock market, shown in blue, it drifts away from what the market would have probably done without the FOMC making its large announcements. And that disparity between the two lines over on the right-hand side is a fairly significant gain, which shows just how influential the Fed has become on us on the stock market. So to that end, we continue to look to the Fed. Over the next few weeks, we've got the payroll numbers coming out next Friday. We continue to think there'll be a major influence in the markets, but it's interesting to see just how large a force they have become over the last decade and a half. Have a very good weekend, and see you next week.